Hey, good afternoon, everybody. This is Chris Lester here, President of Professional Planning Services. I'm attempting to do these every Thursday, 4:30. I went a little long last time, so I'm going to practice on brevity, not do as much of a deep dive. Because again, I want to bring you value, but I also understand that we're all being pulled in a multitude of directions with everything that's going on. So without further ado, we'll get right into it. And today's topic is going to be on just the markets in the month of May, right? It's like a May update. So what's happened? You know, compared to last week's call, you could have walked away from the call maybe a little depressed or nervous or scared. And again, I am just trying to supply data so that we can make good choices going forward. This here is a snippet or a snapshot of the month of April. So, you know, as I go through the colors and the lines, each of these will be dependent upon the economy. The first line I want to draw your attention to is the baby blue line that's in the negative territory. If you look at the legend at the top, everything's color-coded, but this area is commodities. And right now, commodities, this index is heavily weighted in oil. And we all know that oil has just been getting hammered. In a month where you can see an upward trend, that is the one laggard. And it's to be expected because production has been really high and there's not been a lot of need for it. So there's actually an abundance and lack of storage. So as we continue, you will see that the dark blue line leading the pack, and that's identified as the small caps. You know, and that's to be expected, that the small caps typically will take it on the chin first, but they're also quicker to recover. And they were up for about 14% for the month. The next is the red line. That's the S&P. The S&P blue chip stocks, a little bit behind it, and was up about 13% for the month of April. Followed by black, which is real estate or REITs. You can see was about 9%, and quickly following was the purple or emerging growth was about 7 to 8%. Now the teal line, interesting enough, that's gold, and it was interesting to see that that's actually been holding its own right now. And teal's been about up for the month for about 7.5%, and you'll see that on some of the on the next slides when I get into fixed assets or income generating assets. That this also has performed well. And then you see that that green or neon green, that's developed international countries. So more like your Spain's, your Italy's, things like that. Developed companies are up around 6%. So overall, April was a good month. And, coming off a month where, as we get to the next slide, we'll see that, year to date, we all know what happened in March. And so we start to see that trend coming back, which is good. But now we see a little bit of year to date. Again, if you look at the top there, gold has just been doing well. And, is it the place to be right now? Now, also looking at commodities at the bottom are crushed, right? So, year to date, almost 48% down. And that's just ugly, no matter how you look at it. But yeah, gold is up as well. It's in the 10 to 11% range. But then we start to have some negatives, right? We'll start with the least of the negatives, which are the larger blue caps, right? So your S&Ps, your Amazons, your large corporations, typically that might perform better in an environment like this or have the cash to weather the storms, especially if your model like Amazon follows their whole business model is delivery. So this actually plays well, even though they're not in the S&P. It's just something to see that these types of companies have done well. Now we have black next. REITs are down almost, let's see here, year to date, the REITs are negative 18%. The purple developed internationals, emerging markets, all down about 18%. Right, that's that little bit of hodgepodge off to the right. So these three colors are coming into the area, and that's again because it's a global event that we're facing. Dark blue, so month of April, they've done well. They're the quickest to recover, but they were also the quickest to drop the furthest. So we see them down about 22% year to date. And then again, the laggard, that, commodities and just being so heavily weighted, just getting crushed. So, that's just an update on the equity side of it. Now this chart is a lot to absorb, but let me help you to simplify this. The top part of the chart here is what we call the RSI indicator. So there's 3 indicators here. The one that right below that is called the moving average indicator. Seeing if my mouse works right here. And then the one below this is the MACD, or the moving average divergence indicator. And allow me to explain this chart a little bit. What we're doing, and when we're looking at this, RSI, by the way, is a relative strength index. And this is a simple formula that we use to measure trends, right? So if you look over here, you'll see either red lines or green lines as I go left to right. And so all the way to the left is 2000. And then all the way to the right of that a little bit is when 2003 is when the market started to turn. And what will change a line from red to green, or is if all 3 of these indicators go negative at once. So if you recall from last week's call, everything that's been going on in the last couple months is really just a blip in comparison to what has happened in the past, right? We've been through tough times before. Right now, we don't, and nobody will ever know what the future holds. So you have to have strategies as you're in the market. But having technical indicators like this, what you have to watch out for is sometimes you get a fake out. So you see here, I think this is 2006, a little glare on my screen. So in 2006, got a little bit of a head fake, and then it went to green. And you could have missed some of the upsides of some of the points that could have been had in gains. But then here we are in 2008. This was, the bottom started to fall out. So that means all 3 indicators went negative and it was a correct sign. But then a few years later, it went back to green. Now, one of the things I also want to point out, and this is where I caution, I think I cautioned last week and I would caution again, typically the markets don't operate in a V, right? They don't go straight down and come straight back, right? So we may test lows right now, right? So even though we've had some good news, some stimulus, things have, we're getting the economy back and running, right? There still could be tests of the bottom, but it's not a time to run for the hills. I just want you to understand that, because if you try and time the market, it's been proven time and time again, you just can't do that. So the bull and bear indicator just went red at the end of March. That's this line all the way to the right, and that's where we are right now. So does that mean we're on a downward trend? We don't know, because like you said, there's been a couple fake outs along the ways. We're watching closely. So I just want you, at least just understand that there's some logic to the overall strategies that are in the markets right now. So now we're going to get into the income markets, right? So the income markets actually in April have done surprisingly well. And if we look at the colors to the top, right, we have across the top, we have high yield muni bonds. That's this, I guess I'll call that a teal color, right? So they were up about 5%. And then the dark blue, those are high yield corporates. They were up about 5%. Now purple, those were international bond market, up about 2%. And then the red is the aggregate U.S. bond market, up about 2%. And then right below that, you have a light blue. So right in here in this mess, and again, I'm trying to get my mouse to cooperate here, right? Right about 1%, those are long-term treasuries. So the treasuries overall right now are typically a safe haven where people, when they get nervous, they want to go into more secure vehicles. Now the intermediate treasuries are only up about 0.5%, that's this green. And then traditional munis, let me get my mouse working again. And you always look for it and then went the wrong way. And there we go. So there's the light green, and then there's the munis are down about 1.8, 1.9%. And in the municipal bond markets, traditionally people are feel that they're a safe haven, and I caution against the traditional munis just because a lot of what's going on right now is if the municipality is not taking in revenue, either from taxes or maybe they've had to furlough people or whatever, it's just maybe not the safe haven. And I've talked about this before. People think you can't lose money in bonds, but that's not true. But this is a snapshot of 1 month. This is April, and it really overall, the bond market has been strong. But as we go and we look into the year to date, it has overall been pretty good. But you'll see in some areas, other areas not so much. So the top blue line, the baby blue line, that's your treasuries, your short-term U.S. treasuries are up 22%, right? 24% is long-term treasuries, because that's the flight to safety. Just think about it. What happens is they pay very low yield, but when everybody in the marketplace comes to get them, it drives the prices up, which is why the return on investment there. And again, then you have the intermediate treasuries there in the neon green. And then we're back to the red, which is the U.S. aggregate, which is up about 5%. So the neon green was up about 11. U.S. bond aggregate market, so U.S. bond market is about 5%. The purple, which is the international bond market, about 2%. And then again, the black muni bonds, dark blue is high yield corporate bonds. So anytime you hear the word like high yield, you just know that's when you hear the word junk bond. That just means that it's more risk and a higher degree of probability of default, which makes them less valuable, which is why they're feeling pressure right now. And then, so the dark blue high yield corporate bonds are down 8%. And then again, high yield municipal bonds. So people are concerned about their local community bonds are down 14% on the year. So, but when you look at the bull bear indicator here with the same RSI, the moving average, and the MACD, this is actually a very good chart for the bonds, because if you look, we've been on a bull run here, this green line, for about 18 months, right? So as you look into the future, how long will it last? We don't know. Bonds don't like interest rates. Bonds don't default. Those are risks. Right, so just keep in mind that as you're trying to plan out strategies, that having at least an eye on flights to safety and where to go, and then can they generate yield? That's part of a prudent strategy. This is our last chart, which is called the recession probability analytics, and this is an indicator that basically, are we heading towards a recession? Now, this is not necessarily, a crystal ball, but it's just taking data and it's just saying, hey, look, if the number is below, so a number of 1, if you're below 50, or on a scale of 0 to 100, 50 is the median. A number of 1 means we have, we're not going into a recession, and anything above 50 means we're heading into that direction. So this just takes data points from across the U.S. economy, puts it into this algorithm, and then says, look, where are we at? So in March, we were at 49 and some change here, I have to move. So 40.23, but then by the, beginning of April, it jumped up to 69.42. So, there's storm clouds ahead. Now, this is to be expected with all the news that you're hearing, right? We just exceeded 40 million people have filed for unemployment. Now, whether it's furloughs, whether it's permanent, I don't know. But I'm just saying that on the horizon, a recession is upon us or likely. However, that doesn't mean all gloom and doom. Remember, I talked last week that this is America. We will get through this. What it means is but, a lot of things with the economy, what the government's doing, people, are really trying to put money into the economy. There's definite probability that the third quarter or fourth quarter, second half of this year will improve. But right now, with people just being out of work, that's money that's not coming into the marketplace. So this is just an indicator. I wouldn't be surprised if it goes higher next month. But just because we hit a recession doesn't mean that we quickly can't get out of that. It plays into the market. So, that's my presentation for today. If you have questions, please reach out to me. My email is chris@professionalplanningservices.com. I'm going to try and do this every week. Just give you updates on different things. Want to thank you. If one of your advisors invited you on this call today, go ahead and reach out to them with questions. But, just remember, emotion should not drive our decisions, right? Just being able to have statistics and data in front of us with a well laid out plan will get us through whatever curveballs life might throw at us. So, guys, thank everybody for being on the call today. Really want to thank you. And if you need me, reach out. Have a great day.